With the cost of living crisis, most retail outlets have been performing pretty poorly of late, and with no end to the financial misery in sight, could supermarket shares be the best in the sector? Everyone needs to eat, right? In this video we'll take a look at two of the UK's biggest chains and one that may be returning to its glory days. The reason I'm looking at grocery retail stores is because although purse strings are tightening for the majority of the general public, groceries are one of the things that you can't really cut back on, and not only that, a lot of these stores are branching out their income streams as well. I'll start off by taking a look at Tesco. Currently trading just under the 250 pence mark. They could easily be seen as great value, seeing as they are the market leaders. Tesco accounts for over a quarter of sales in the grocery sector, which is impressive considering just how much competition there is out there. Since the start of this year, we've seen the share price rise pretty steadily from just under 230 pence. That's just over a 7% uplift. A lot of this has been due to supermarkets reporting healthy footfall over the Christmas period. There was a lot of speculation before Christmas that retailers would be hit heavy due to the cost of living crisis, but luckily for them, this didn't factor so much into people's spending. One tricky balancing act they've been playing is sourcing products at competitive prices, but this is a two-way street. Last year we saw Tesco failing to stock some Heinz products as they didn't see the price increase imposed by Heinz as viable. Moving forward, with more and more companies seeing their production and supply costs mounting, we could see more of these problems for Tesco, and of course their competitors. But with Tesco holding such a massive market share, they may well be able to use that as a bargaining chip to leverage some of those costs down. Another potential problem Tesco may face moving forward is a tendency to operate with paper-thin margins. This has been a tactic they've used for some time now, assumingly as a way of keeping costs down, so they can then in turn keep prices low. But it does mean they are less likely to be able to absorb sharp rises of prices, and with the instability we've seen over the last few years, this could certainly be something that impacts their profits. One thing that may help to mitigate any future dents in their profit though, is their expansion of digital advertising within their stores. Having recently added more screens to their stores, their advertising network has a potential to reach over 6 million customers every fortnight. As the infrastructure is already in place, I can imagine that this could be quite lucrative for the company. Just don't forget to borrow Roddy Piper's shades next time you pop out for some milk. I do try and invest in ethical companies, and in firms that treat their staff well. I think a happy workforce is a productive workforce, and with that, you're less likely to see industrial action within the firm. Looking at Tesco on an ethical basis, there are a few things that leave a bad taste in my mouth. There is an upcoming lawsuit relating to their F&F clothing brand, and looking at the wages their staff are on compared to the heads of the company, there seems to be a lot of imbalance. From what I can tell, staff did receive extra discounts in store before Christmas, but rather than receiving a bonus, some received just a box of chocolates if they were lucky. Whereas the CEO is reported to have taken home a £3.21 million bonus in 2022 alone. Their Chief Finance Officer also took home £5.4 million. That's a lot of box of heroes. This kind of penny pinching at the bottom end while the heads take home eye-watering amounts doesn't sit well with me. Let's take a look if the competition do things any differently. Next up is Sainsbury's. They're currently trading at a very similar price to Tesco, just under the 250 pence mark, and have seen a similar rise to Tesco so far this year at just under 8%, but their market cap is significantly lower than Tesco's. Sainsbury's were looking like a lost old beloved family dog stuck in a muddy puddle for a while, but have certainly been regaining focus these last few years. With stores integrating other brands such as Habitat and Argos, they certainly seem to be trying to entice customers in with big brands and a wide range of products. These days convenience is key, and Sainsbury's seem to be trying to capitalise on this by bridging the gap between department store and supermarket. Looking at the company's financials, they look to be in better shape than Tesco, with a price to earnings ratio half of Tesco's at just over 10. If, like me, you're looking for dividend income, then Sainsbury's could be the better bet. Both Sainsbury's and Tesco dividend yields sit around the 5% mark, but Sainsbury's dividend is covered twice over, whereas Tesco's cover is only just over 1. With many market analysts predicting a less rosy future for the grocery market, dividends could well be cut, but I think Sainsbury's could potentially cut theirs less than Tesco, but of course that isn't guaranteed. But looking at the figures, Sainsbury's gives me that little bit more comfort. Like Tesco, the CEO of Sainsbury's got paid an eye-watering amount in the last financial year, receiving a whopping £3.8 million. Although they have upped the basic pay for their staff to a fairly decent £11 an hour. Some of their major shareholders could throw up some ethical red flags as well, with one of their major shareholders being Qatar Investment Authority, who have a 14% stake, and Czech billionaire Daniel Kretinsky's investment firm Visa owning a 10% stake. The last firm we'll be looking at today is Marks & Spencer, a British staple that has a rough time over the last decade or so, and one that has struggled to find its way. The share price currently sits around the 150 pence mark, but it's in a 15% uplift so far this year and a whopping 45% over the last 3 months. Is this justified though? There has been a lot of speculation whether chains like M&S would weather the economic downturn well as people cut their spending and perhaps chose discount stores instead, but their Q3 results came in surprisingly strong. UK sales nearly doubled expectations at just under 10%. There's currently no dividend paid by M&S, but this could be reinstated this year if sales remain strong. The company has a clear plan in place to focus the company's direction moving forward, and that plan seems to be working. Of course, the retail environment is an ever-changing beast, so how they perform in the near future depends how quickly they can adapt to things like increasing inflation and focusing their market to keep up with the discount stores. If consumers don't feel like they're getting the extra quality they're paying for, then there won't be any reason for them to stay and may well look elsewhere. M&S are showing they have faith in their numbers by announcing they're to open 20 more stores. At a time when a lot of companies are closing stores to streamline costs, this could seem risky, but M&S have already trimmed a lot of fat out of their operational network as part of their streamlining plan. They've also set aside £150 million to tackle added costs such as the rising energy bills. Let me know below what you think of supermarket shares and how you think they will fare in the near future. For me, I don't think I'll buy any yet, but I'm certainly looking to add some to my portfolio for a bit of diversification. If I was to jump in, I think I would take a risk with M&S, as I think they have the most to gain in the short run, and if a dividend was announced, that could well persuade me. That's it for today. Don't forget to leave a like and subscribe for future content. Hope to see you again soon. Peace.